Welcome to the Three Edge Week in Review for the week of February 14th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge. And joining me here today, once again, is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, along with a quick recap of the week's activities in the markets, Steve and I will be discussing a topic that's very much related to last week's discussion about the yield curve. And that topic is real interest rates, which are often referred to simply as real rates. And real interest rates are simply represent nominal interest rates adjusted for inflation. Today, we'll discuss the difference between nominal rates and real rates and why it's important that investors understand this concept. But first, a quick market update. And markets continue to be whipsawed by the ongoing global tensions over the Russia-Ukraine situation. Early this past week, Russia seemed to send a signal that perhaps they were going to begin to pull back from the Ukrainian border. However, the reports on the ground indicated that this was not happening and the situation remains tense. Then on Friday, there was news that the U.S. Secretary of State Blinken will meet with his Russian counterpart, Sergei Lavrov, next week, and this had somewhat of a calming effect on the markets at the end of the week. Meanwhile, news on the inflation front this week was not encouraging. On Tuesday, the Bureau of Labor Statistics reported that the producer price index increased by over 1% from the prior month, and year over year, PPI rose by over 9%. The producer, it's a tough one. The producer price index, PPI, measures inflation from the perspective of cost to industry and producers of products. And therefore, it measures price changes that producers may then pass on to consumers in the future, meaning future inflation is potentially being embedded in the entire value chain, and therefore inflation may not be going away anytime soon. It was, however, another good week for the price of gold, which reached an 8-month high this week with an assist from the tension between Russia and Ukraine as investors sought haven assets. So now let me bring Steve into our conversation. And Steve, last week we discussed the yield curve. And we're also hearing investors talking about and asking us questions about real interest rates, which I said earlier just represent nominal rates adjusted for the effects of inflation. And we know that real rates can be an important factor that can drive the capital markets in one direction or the other. And we also know that real rates affect different asset classes differently. So let's start by level setting, and let's begin by having you provide a working definition of real interest rates.
Well, Fritz, the classical definition of real rate or real interest rate is what's known as the Fischer Equation, and you can see this on the accompanying chart. It's basically the change in your nominal interest rate divided by the change in the inflation rate, and then you subtract one to create a percentage. But there's an even easier, simpler way to think about real rates, and you get almost exactly the same result. You simply take your interest rate, for instance, your 10-year Treasury bond yield, and you subtract your inflation rate. Now, sometimes you just subtract the consumer price inflation rate that is of the current time, and then sometimes you use an expected inflation rate.
All right, great. So I'll stop you there. So let's look at that a little more closely because, as you said, so people sometimes will use expected inflation, sometimes they use actual. So the question would be, why would you choose one over the other? Would it, and what would be the difference between using them?
Well, let's say we wanted to calculate the real interest rate or the inflation adjusted interest rate over the next 10 years. So ideally, we would start with the 10-year Treasury bond yield,
Mhm.
and then we adjust that with inflation. But the inflation rate that would be appropriate would be what would the inflation rate average over the next 10 years? Of course, no one has a crystal ball. We don't know exactly how inflation is going to average over the next 10 years. So we have a couple of choices. Simplest one is to just take today's inflation rate as a proxy for what it's likely to be over the next 10 years. But another choice would be to take the market's expected inflation rate over the next 10 years as what you use to calculate the real rate. And we can get that, anyone can get that by simply using the TIPS market TIPS, or Treasury inflation protected securities, are just like regular Treasury bonds, except the principal value of the TIP adjusts at the rate of inflation. What that means is by simply taking the 10-year Treasury bond yield and subtracting the TIPS yield, that difference is exactly what the market expects inflation to be over the next 10 years. And so it's an easy way to find out what the market's expected inflation rate is.
Great. All right. So great. So now we have our working definition. So maybe now it's helpful if you go into a bit more detail about what can drive real interest rates. For example, what does it mean if real interest rates are negative? And how do real rates affect different asset classes and why?
So throughout time, what's normal and what we mostly experience are positive real interest rates.
Mhm.
If you take the 10-year Treasury bond yield and you look at uh, what inflation is compared to the 10-year Treasury bond yield, usually investors get about 2 to 2.5% interest rate above positive real interest rate above inflation to compensate them for lending money to the government.
Okay.
That's normal. Once in a great while, we have a very abnormal situation we call negative real interest rates, where you lend money to the government by buying a government bond. You don't even get compensated or paid enough to cover inflation. That's not a normal situation. And we call that negative real interest rates. Why it's so important now is that right now, we and most of the rest of the world are experiencing negative real interest rates. And that has serious consequences. It's an abnormal situation. It's a signal that the markets are out of balance.
Mhm.
If negative real rates persist, then inflation may persist for some time. Now, let's take a look at today's situation with the accompanying chart. So, what we see here is for most of the last 40 years, we've had positive rates. You see the line that shows the 10-year bond yield above inflation for most of the last 40 years.
Mhm.
All of a sudden today, it's completely flipped, and now we have inflation shooting much, much higher than the interest rate. So we are in a heavily negative real interest rate situation today. Last time that happened was in the 1970s. And similar to now, when inflation started to pick up in the 70s, the authorities said it would only be temporary, don't worry. And then they began to get worried, but they try to control it through wage and price controls and telling people to be careful with their spending, et cetera. And of course, none of that worked. And the Fed was too afraid to raise interest rates high enough to fight and to cause the negative real interest rate to go away to fight the inflation. And this persisted for a whole decade until Paul Volcker, the head of the Fed in 1980, 1981 timeframe, finally had to raise rates all the way almost to 20% to create positive real interest rates again. So it's a lesson not to wait too long. But I fear that the same thing might be happening now. Another parallel was the 1940s. After World War II, the US government had an enormous debt, similar to today's debt as a percent of GDP. And the way it paid off its debt was it kept interest rates below inflation for an extended period, again, negative real interest rates. And that meant that bondholders were in effect subsidizing the government by accepting a yield below the rate of inflation. And you can think of that as an inflation tax.
Yeah, otherwise known, right, as inflating your way out of a bad debt situation that you have, maybe.
Exactly, exactly right. Now, there's another asset class we should take a look at, which
Mhm.
is gold. And we have another chart that shows the incredibly strong reverse relationship or inverse relationship between gold and real rates. The blue line shows real rates. When the blue line falls, gold rises. It's almost a perfect mirror image. And, and it makes sense if you think about it. Why should you be in gold, which generates no interest income, when you can be in a bond and generate an interest income far, far above inflation? You're getting a real return.
Mhm.
On the other hand, why should you be in bonds when you're not even getting compensated for the rate of inflation? At least you can be in gold and keep up with inflation. So
Mhm.
it's no surprise that gold does well when real rates fall, and gold does badly when real rates rise. Now, I'm going to show a second chart that shows what could happen if investors' expectations, if the market's expectation of inflation rises as they lose faith in the Fed being able to control inflation because the Fed has been so far behind the curve. You could see how real rates reflecting more of the current rate of inflation, or a blend between expected inflation as the market sets and actual inflation. You could see how that blue line drops pretty sharply, and gold might have some serious upside potential should investors' inflation expectations start to climb.
So very good. So as always, my last question concerns our outlook for real rates first, those interest rates adjusted for inflation, and how that may play out in 2022, and how investors might consider positioning themselves for a shift in the real interest rate environment.
So far, the Fed has shown almost no appetite to be able to move out of this negative real interest rate environment into positive rates. So because of that, they fell way behind the curve. And now it would take extraordinary number of hikes just to get back on top of inflation again. So we could be in a negative real interest rate situation for a very long time. And partly because I think the Fed is afraid of either causing the next recession if it acts too quickly, or now that the government is so over indebted, and there are businesses that otherwise would never have been able to access the bond markets and borrow money, but are now over leveraged and overextended. If rates go up meaningfully here, it could cause a lot of pain, a lot of hurt to the government in terms of interest expense they would have to pay, and to businesses. So they seem to be reluctant to do what it takes to get back into a positive real rate scenario. If that's the case, inflation could be around longer than people expect. And what we would recommend from an investment point of view is, rather than thinking of hedging your equity portfolio only with bonds, it's really important to think of real assets as perhaps a better hedge. And real assets being gold, being commodities, and also TIPS, so Treasury inflation protected securities, because principal value keeps up with inflation.
And actually, year to date, both gold and commodities have held up quite well, as we've seen the equity and the bond market wobble there. So great. Well, thank you. That was an excellent overview of real interest rates and why they're important. So that will do it for Steve and me. Remember, all our videos are available on our 3Edge YouTube channel. If you could take the time to like our videos, if you do in fact like them, we'd be most appreciative. In addition, all our videos and all of our written content as well are always available on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.